In this video, I'm going to be talking about what external range liquidity and internal range liquidity is, and also how these two concepts move with each other. So first, we're going to be talking about what external range liquidity is. So external range liquidity is buy-side liquidity or sell-side liquidity. And then internal range liquidity is either a fair value gap or a swing high within external range liquidity. So price moves from either external range liquidity to internal range liquidity or internal range liquidity to external range liquidity. And it's very unusual that price moves from external range liquidity to external range liquidity. So right here I have two examples of how price moves from internal range liquidity to external range liquidity on both sell side of the curve and buy side of the curve. So first of all, we talked about what internal range liquidity is, and that is swing highs and fair value gaps. So then when we want to see price moves from internal range liquidity to external range liquidity, we have to wait for confirmation that price is willing to go lower from this value gap. And that could either be a change in state of delivery or a inversion value gap. Because if we don't have any confirmation and we just short up here, price could invalidate this value gap and then go up to the other side of the external range liquidity. And same over here on the buy side of the curve, as we see price moves down to internal range liquidity. And remember, the internal range liquidity has to be within the external range liquidity. So then we see price moves from internal range liquidity, and we wait for a confirmation that price is willing to go up to this external range liquidity. And as I said before, we have to wait for a confirmation because either price could invalidate the internal range liquidity and go to the other side of the external range liquidity. So this is how price will look like if it moved from external range liquidity to external range liquidity. And as I said before, it's very unusual for price doing something like this. Now I'm going to show you how price moves from external range liquidity to internal range liquidity. So over here on the sell side of the curve, we see price takes out external range liquidity, and then it moves up to internal range liquidity. And then after that, we create a new low, so a new external range liquidity. So then, as I showed you before, price could move from internal range liquidity to external range liquidity again. And over here on the buy side of the curve, we see price takes out external range liquidity, and then it moves down to internal range liquidity. And then we made a new higher. So this is external range liquidity. So then price moves from internal range liquidity to external range liquidity. And usually this high up here, before we take out external range liquidity, is a intermediate term high if we touch a fair value gap, and the same over here, this low would be an intermediate term low if we touch a fair value gap. So now we can go into the charts and find some examples on how price moves from external range liquidity to internal range liquidity, and from internal range liquidity to external range liquidity. So right here we have this low down here, which is external range liquidity, and we have this high up here, which is also external range liquidity. So now we will wait to see if price takes out external range liquidity. And right here we see price takes out external range liquidity. So now we would like to see price moves up into internal range liquidity, which is up here. And right here price moves up to external range liquidity, which is right here. And we also created a new low from this low down here. So this is now external range liquidity. So now we want to see price take out this external range liquidity. And right here price takes out external range liquidity and moves from internal range liquidity to external range liquidity. So now this down here is external range liquidity. So internal range liquidity could either be one of these volume imbalances we have within here, or it could be these swing highs up here. So let's see what happens. Right here, price closes above these two volume balances. So now internal range liquidity would be this high up here. Right here we see price take out internal range liquidity. So now we would like to see price go to external range liquidity. And right here we see price move down to external range liquidity. Also, price continued with moving from internal range liquidity to external range liquidity. Let's see up here, this value gap is internal range liquidity. Now we want to see price move down to external range liquidity. And right here, price moves down to external range liquidity. So for this example, we see price moves from external range liquidity to internal range liquidity, and from internal range liquidity to external range liquidity. Right here, we see price of taking out external range liquidity, and then we want to use our Fibonacci tool from external range liquidity down here to the new external range liquidity to determine the premium and discount, and then we want to find internal range liquidity within the discount of the range. And that we have right here with this fair value gap. And also we see price of consolidated. So then we could anticipate a manipulation leg down into the discount of the range and into internal range liquidity. And then we could see distribution up to the new high we formed up here, which is external range liquidity. And then we see price do right here. So we also touched this inversion value gap. And if you were to take a trade entry, you could enter right when we get the body close above this inversion value gap, because that leads to a confirmation that price is willing to go higher. So then we could enter right at the close and put our stop loss at the bottom of the inversion value gap and then target external range liquidity. But that would only make a 1.8 risk reward ratio. So in that case, we would just target 2 risk reward ratio. And as we see, price target hits the 2 risk reward ratio. So just to simplify the trade a bit more, we could see price moves from external range liquidity up here down to internal range liquidity. And then we use our Fibonacci tool from this low down here, which is external range liquidity, up to this new high up here, which is external range liquidity. And then we can determine the discount and the premium and find internal range liquidity within the discount. And then we see price go lower down here. And then we see price move higher, closing above this inversion value gap. So then we would enter right at the candle close above the inversion value gap. And the reason we wouldn't enter at the internal range liquidity is because, as I said before, we need more confirmation that price is willing to move higher. So then we see price close above this inversion value gap, and we get a lot of momentum all the way up to external range liquidity. So then we will enter at the close above the inversion value gap and put our stop loss right at the low of the inversion value gap, because we need to have a strict stop loss, because if you were to have your stop loss down here, you only have a 1.1 risk reward ratio. We also had a AMD model, which also supports the idea of higher prices. So as you see, price consolidates, then price manipulates down into internal range liquidity, which is within the discount, and then price distributes higher. So already we have actually 3 confirmations that price is going to go higher. First of all, we have the AMD model, then we have internal range liquidity, and then we have the inversion value gap. For the next example, we see how price moves from a high time frame PD array, which is internal range liquidity, up to external range liquidity. So right here we have a hourly value gap, which price respects and move up to external range liquidity up here. So if you were to take a trade entry, you wouldn't enter right when we touch the internal range liquidity, because we have to get more confirmation that price is willing to go higher. Because if you were to enter at the internal range liquidity, price could disrespect it and then move lower. So I would wait for maybe a inversion value gap or a change in state of delivery. So right here we get a inversion value gap, and then I would enter at the either at the candle close above the inversion value gap, or if we get a retracement. So then, if you were to target the external range liquidity and put your stop loss at the low we formed when we touched the high time frame PD array, it would only make a 1.2 risk reward ratio. So in that case, I would maybe move my stop loss to a more strict place, maybe below the slow or at the low of the value gap. So in that case, if we enter at the candle close, put my stop loss at this low we formed right here, it will make a 2.3 risk reward ratio. So that was it for this video on what internal range liquidity and external range liquidity is and how these two concepts move with each other. So if you like this video, please like and subscribe. And if you have any questions or have any ICT concepts that you want to learn more about, just comment down below. And if you also like to engage with other traders, you can join my Discord, link in the description. It's totally free.